Good afternoon, grade 10s. This is our first video in a series of videos on accounting, my absolute favorite topic. I hope you guys enjoyed as much as I do. So let's get started. What actually is accounting? I know you've heard the term before. We've talked about it a lot in this course, and we've even done some stuff with respect to our businesses on accounting already. But accounting is basically the language of business. What this means is, no matter where you go in the world, you'll be able to understand the same language. For example, if you could speak French and you go to France or Quebec, you'll feel very comfortable and you'll be able to get by. If you know accounting, the same thing. If you understand the language that goes with accounting, then no matter what business you're in, no matter what part of the world you're in, you'll be able to understand, which means you'll feel comfortable just like you would speaking French in a different country if you knew French. Basically, accounting is the process of recording, analyzing, and interpreting the economic activities of a business. Now we're going to go into some of the recording, some of the analyzing, and some of the reporting as well that we do as accountants. And we're going to do bits and pieces of each of these in this course. If you take the grade 11 accounting course and the grade 12 accounting course, go into quite a bit more detail. And I encourage you guys to do that. In other words, accounting is the recording of all financial transactions. So financial transactions we're going to talk about. So this is an example of a transaction would be when you make a sale, and you guys will all be making transactions in your business, either buying inventory, selling inventory, buying supplies, paying people back that you owe, getting a bank loan. All of those things are financial transactions. And we need to record them as accountants in order to then, in the future, analyze whether or not the business is making money or not. Accountability is also a big part for accountants, which means we need to be responsible and be able to explain any shortages or discrepancies or strange things that are happening in the company with the numbers. Financial statements are statements that we're going to prepare, and we're going to learn how to prepare income statements and balance sheets in this course. And in the grade 11 course, we go on, and 12 course, we learn all of the financial statements. Basically, they are the reports that summarize the financial purpose of the business. So if your purpose is selling dog food, well, these reports will summarize how successful you were. The income statement will show how much income you have made, basically your revenues and expenses, and your balance sheet will show all of the assets and liabilities that you have running that business. Financial statements must be presented to shareholders. Now, we all know what shareholders are. Basically, we're all shareholders in our Investopedia financial stock market challenge game that we're in. For any of those businesses that you guys have bought shares in, you should be able to look up their annual report, which includes all of the financial statements for the business. So any publicly traded corporation must share their financial statements with the public. So here are two financial statements, a balance sheet and an income statement. And a balance sheet lists all of the company's assets, their liabilities, and their equity. And I'm going to talk about what these things are on the next slides. An income statement is a financial statement that shows the net income of a company, which is basically their revenue. And we've talked about revenue in this course, which is our sales. And it's minus all of our expenses, which leaves us with the net income. So let's take a minute here and let's talk about net worth. Your net worth is a measure of how valuable you are in terms of dollars. So basically, what I want you to do is pause this video in a minute, and I want you to list down all of the things that you own. You own a cell phone, you all own computers, some of you might own some bonds, some of you might own some cash, some of you might own some money in a bank account. List as many things down in terms of dollar values that you can. And then subtract anything you owe. Do you owe money to your mom? Do you owe money to one of your friends? Do you owe money for a field trip that you have to go on? And if you take what you own and subtract what you owe, Basically, this is what your equity is. So take a minute, pause the video, and list all of these things. Basically, companies do this on the balance sheet. They list everything they own, and they subtract anything they owe, and they come up with the owner's equity of the business. And we're going to be looking at that on the balance sheet. And there's an accounting equation that we're going to look at that is going to help us with that. A little question for you. Are any of your assets more liquid than others? The term liquidity is a term that we use in accounting quite often. And basically, liquidity is how quickly an asset can be turned to cash. Or basically anything you own, can any one of those items be sold more quickly than others? For example, I could probably sell some supplies or equipment much faster than I could sell some bigger assets like buildings and land. So the ease with which you can sell an item you own determines how liquid that item is. Okay, here are also some new terms. Asset. You've heard me use the term asset before, and I'm sure people talk about assets. You've heard the term asset before with respect to when you're making your resume and when people ask you what are your greatest assets and things like that. Well, in accounting, an asset is something that has value and you own. Okay, like those items you just listed on the other page. You were talking about your computers, your cell phones. Those are items that you could sell, which means they have value, and you own them. So an asset with respect to a business is something that has value and is owned by a business. These are things like cash, supplies, equipment, building, land. Those are all assets, and assets are very important when we're talking about balance sheets. Liabilities. Well, you've also probably heard the term a liability in lots of different references out there. Maybe you've heard the term, oh, he's a liability to the team, which means he might not be contributing as well as other team members. Well, in business, the term liability is what you owe to someone. It's a debt. And by the way, the term debt has the letter B in it, and be careful not to pronounce it debt. Okay, so it's a debt or amount owed by a business. We owe lots of things in business. We owe telephone bills, we owe hydro bills, we owe money to our employees for salaries, we owe taxes. All of those things are liabilities. And of course, the term equity we talked about on the last page a little bit. It's really the net worth of a business. So if you subtract your liabilities from your assets, you will get your equity. Just like we did on this slide, we subtract our items that we owe, which are our liabilities, from items that we own, which are our assets. And that would be our own personal net worth. Or equity is another term. Another term for equity as well is capital. All right, here's the fundamental accounting equation that we're going to use. Basically, if you take your assets, they should equal your liabilities plus your owner's equity. OE stands for owner's equity. It is the net worth that we just talked about on the last page. Or assets minus liabilities equals owner's equity as well. I very rarely see this one. Liabilities equals assets minus owner's equity. So I wouldn't worry too much about these ones. But basically it's the same formula, just rearranged in different ways. Often we need to calculate what our net worth is. So this one here is the one that we would use. We subtract our liabilities from our assets to get our owner's equity or net worth or capital. Remember, those three terms can be interchangeably right now. And often when you see the setup of the balance sheet, we will have assets on the left side of our balance sheet, and it will equal our liabilities plus our owner's equity or our net worth or our capital on the right-hand side of the balance sheet. Okay, really quickly, just want to talk about chartered professional accountants. In Canada, there used to be 3 different designations. In order to become an accountant, you could have become a CA, which was a chartered accountant, a CMA, which was a certified management accountant, or a CGA, which was a certified general accountant. Now, all 3 of those organizations have come together in the past year and a half, and they are now the Chartered Professional Accountants. So if you want to become a professional designated accountant in Canada, you would become a CPA now. No longer can you become a CA. And in the States, they also have CPAs, but they are not called Chartered Professional Accountants. They're Certified Public Accountants. Either way, accounting is a profession, and just like any other profession, you need a license in order to operate. And so a designation, your CPA would be your designation, kind of like your license to practice as an accountant. Okay, so what I want you guys to do is pause this video and just briefly find some roles and responsibilities of a CPA. See if you can find an expected starting salary of a CPA. See what the schooling that is necessary to become a CPA, and find some professional experience needed also to become a CPA. This website here, cpacanada.ca, will really help you with that.